The Fed is not going to pivot, and Jerome Powell, he doesn't care what happens to the stock market. Because look at the VIX right now. The VIX is not spiking. Unemployment is not budging. Real GDP is still positive. The Fed funds rate is still increasing, and the market is still declining. Of course. So on Saturday, I get an alert from the Atlanta Fed's Economy Now app that I have on my phone, and it says GDP growth in the fourth quarter of 2022 is 3.2%. Down from 3.4%. Now, this was on Saturday. Guess what I just got today? A few hours ago. Now it's at 2.8%. Okay, it went from 3.4% to 2.8%. So what's going on here? Well, look, GDP is actually starting to go down. Okay, so maybe I'm wrong in what I just said in the start, or maybe I'm not. So here's the deal. Well, if we look here, we have negative GDP growth back in the first quarter of the year, March of 2022. Then we have negative GDP growth again, negative 0.56. Same deal. Now we have positive GDP growth in September, so third quarter of 2022. So from 2.9% back last quarter until today, where now we have a potential GDP estimate growth of 2.8%. So now it's going down, it's trending down. I'm trying to say is that, okay, maybe what the Fed is doing, the hiking of interest rates, is actually working, but is that actually good for the stock market? Is that good for what might happen to our investments if we're invested in the short term, let's say? If we take a look at unemployment, unemployment's not going anywhere. It's not budging. 3.7% unemployment right now. Okay, it's not budging. It's pretty much right around where it's been for the past almost 2 quarters at least. Unemployment is not really going up. What's the reason that the Fed really needs to be scared right now if unemployment is not increasing? And GDP is still actually positive. Real GDP is still positive, and it's maybe trending down a bit, but still 2.8% positive real GDP is nothing that the Fed is going to be too scared about. And so all I'm trying to say in this so far is that I don't see anything that the Fed should be really too worried about right now. And so if we put the Fed funds rate over this, which is the blue line here, and we could see that as the Fed funds rate is continuing to increase, unemployment's not going up right now. So unemployment is staying down. As long as unemployment stays down and they're increasing this rate, they're not too scared right now. When I think what happens with us type of stock market investors, who are probably a lot of you watching this video right now, and like me, I'm always looking at the market and I'm thinking everything that I'm thinking about what's going on right now in the economy, I associate with what's going on in the stock market, because stocks you would usually think have an effect on what's going on in the economy. But at the end of the day, unemployment's not going up too fast, GDP is not going down too much, and the stock market, while it is down quite a bit, that are going to make the Federal Reserve want to do anything drastic like have a pivot. In my opinion, I don't see that happening. If we're looking right now at the VIX is probably the most important thing that we need to look at if we're going to talk about if Jerome Powell is going to head fake us and do a little bit of a pivot, right? So the only way that this is going to happen is if we get a huge spike in the VIX. And what we're seeing right now is the VIX is fine. The VIX is in the 20 area. We get spikes in the VIX. When the VIX gets like to 60 plus, that's when you're worried. That's when people are going to be really freaking out about something. That's when you see huge potential for Fed pivot. Basically, as long as the VIX is not spiking, the Federal Reserve doesn't have anything probably to worry about. The Fed doesn't care if the stock market tanks 50%. They really don't care. What they care about is giant potential of volatility, because if there's volatility in the market, there's a huge reason and an underlying factor. Because take a look at the volatility here. When it hits 82, that's COVID. Giant problems, of course. Not like what's going on now, which is a problem, but it's not what was going on back then. Here's another giant spike in the VIX. Oh, what was happening during this period of time when we hit 80 on the VIX? Oh, it's 2008, the Great Recession, the financial crisis, 2008, 2009. What was happening? We had really systemic issues inside financial markets, right? And those were things that were going to bring the VIX to a high enough level that a Fed might need to pivot. If we don't get something like some type of contagion event where something in the market is really breaking, we're probably not going to get some type of pivot from the Fed. What's probably going to happen, in my opinion, they're going to keep raising rates. As you can see, look how low it was back just 1 year ago today. It's basically 0%. Now we're up at 3.8. We're going to 4. We're probably going to go up to 5-ish. Probably going to just sit there for a while. That's probably what's going to happen. Unless, of course, like I said, the VIX spikes. We can take a look here at CPI numbers, yellow being the core CPI number. We have headline inflation being the purple CPI number. And we have the Fed funds rate, of course, going up to 4. Look, we have a declining CPI, so inflation's coming down a bit. Fed funds is going up. They're going to find equilibrium probably in the 5 area next year. It might sit there for a while, and then at some point the Fed's going to see, yes, hopefully inflation does come down, and then the Fed is going to start saying, okay, well, I think it's time for us to start cutting rates. This could increase, and what happens if it increases? Well, same kind of deal. Why would the Fed stop rising interest rates if suddenly CPI goes up? So that's actually a bad thing too. So either way it goes, I really don't see the Fed, I don't see Jerome Powell, I don't see them going out and saying, we're going to be cutting rates anytime soon. Meanwhile, what does that mean for the stock market? Well, look, we are battling a crazy downtrend right now. Okay, 1, 2, 3, 4, 5 hits on this downtrend channel. Let's zoom in here for a sec. This black line is the year end. So in order for us to get basically a positive number on the S&P 500 by year end, we'd have to be up here. We're not going to be there by the end of the year. We're not even close. We got 3 down candlesticks right now. It's not looking good. And by the way, what do we have right now? We have a crazy volatility day coming up. And basically what I'm talking about is actually today, probably when you're watching this video, unless you're watching it on Saturday or Sunday, but Eastern time in the morning on Friday, this is going to be occurring. So basically this is going to be occurring later in the day, probably in the market. So we have something called quadruple witching. And what happens here is stock options, stock index futures, stock index options, and single stock futures derivatives contracts all set to expire. This happens once every quarter. Back looking here at the S&P 500 and its downtrend, on the top we have volume. Well, let's expand the volume. And the dates when these quadruple or triple witching occur, which you saw in my last video, but I'll go over it again here, are all the giant volume spikes in the market. Okay, here, Friday, September 16th. That was a triple or quadruple witching day. Same here. 17th of June, same here. 18th of March, they're always on a Friday. It's the third Friday of the last month in the quarter. Tomorrow is the day, or today, sorry, is the day that this is going to happen. And if we go back and we see what's going on in the S&P 500 index, like I was saying before, this downtrend channel, okay, it's possible that the triple quadruple witching that is happening right now, maybe it does give us enough volume that we can bust out through this downtrend. If that does happen, that's going to be very, very, very bullish. The end of the year, let's say. Do I think we'll get back up to positive for the S&P 500? No, we're not going to. There's no way. In fact, in order for us to get there, we would have to end up going up about 22% from where we are right now. So imagine the rip in the market if we were able to do that, but probably not. But if we did get above this downtrend line, it would be very, very good for, let's say, the prospects of short term, say the first few months of 2023. That would be great. The last thing I want to talk about is market breadth. Down at the bottom, we have a little indicator. It's market breadth. So let me expand this so we can see it. And so what are we looking at here? Well, this is basically how many stocks are trading above their 200-day moving average. So if it's green, they're trading above. 50% of stocks are trading above their 200-day moving average. If it's red, 50% of stocks are trading below their 50-day moving average. So for example, see back in October and September, only like 1 or 2% of stocks were trading above their 200-day moving average. Pretty much all stocks are in downtrends. No stocks are in uptrends. And that's what's going on in, let's say, the short term, the past 200 days in the market. Zooming out a bit, we could see in this box here, this is when the market was really ripping, right? So we had COVID here, and we had, a market rip for quite a bit of time. All this green on the top, as you can see, most of the time, most of the stocks are above their 200-day moving average. You get down to about 8% only they're above their 200-day moving average. In general, you could see that most of these little red parts, they come and they go really quickly. Now we have much deeper red parts. So we're down to like 1%, we're down to like 2% at certain time periods, and they're longer and they're bigger. And so what's happening here is when you're in a downtrend, you're not getting participation. There are not enough stocks that are participating in rallies. And so what you want to see in here is you want to see big green areas here, and you want to see them nice and high, right? You want to see big rallies. You want to see market breadth. You want to see all the stocks participating in rallies, meaning that they're all trading above their 200-day moving average. Of course, not all of them, but a majority of them, as many as you can get. You want that to happen. Plus, maybe when you're able to break up through that downtrend channel that I was just showing you before. So if we could get market breadth, if we could get a lot of volume, maybe from the quadruple witching, and we can break up through that downtrend line, hey, that could be a new beginning of the next part of this market. So will it happen? Hey, let's see what happens today. You may be watching this and it's already happened, so go check the market and see how it did. If the market was really up a lot today, could be good, but I don't know what's going to happen, so we'll just have to see. Thanks for watching. Hit that like button, subscribe. See you next time.